All right, welcome to our last week of lecture for the spring semester. We're going to be going over the review document, which I have pulled up, and I'll also have the answers pulled up so we can go through and explain why each of the answers is as it is, and hopefully hit a couple of those areas that were more confusing for you throughout the semester. I just briefly went through the exam. I made it up about 2 years ago, so it's still very relevant. I didn't need to change much. And so I think I can give you a couple, hopefully, pointers on things you may want to include in your notes before you go to the proctoring center and take the test anytime between now and through Saturday, May 9th at noon would be the cutoff when the exam closes, and you'll be forced to submit at that point. Okay, so let's just jump in. Oh, one other thing, remember to also do the VITA. The VITA final exam is due by that Saturday, May 9th at noon as well. It's very similar to the basic, very same format. Okay, IRA versus Roth, 401k, and pension. I do have definitely a few questions over the IRA and Roth IRA sections, knowing when can you contribute to an IRA and or a Roth IRA. What are some of the stopping points with an IRA, meaning like you can't put in after you're 70 and a half. There are some other regulations. When can you take money out? Number 59 and a half. But the Roth doesn't have some of those requirements, but it does have its own requirements. So definitely go back and review Chapter 11 and go through the notes that we had that I had listed for the class. You can also go back and rewatch that lecture. And there was also some points on the test about if one individual made X amount and the other individual made quite a bit less, and they didn't have an opportunity at their work to put money away into a retirement plan, could spouse B still put money into an IRA even though spouse A did have a retirement plan option at their work? And there were some cutoffs. I'll give you the phase-out cutoffs, but I want you to be able to know if they can deduct and how much they can deduct. Because after a certain cutoff, you can't put into an IRA if you already have a plan at work or an option of a plan at work. But no, anybody can put money into an IRA. There is no cutoff for that. You can put money into an IRA. It's just, are you allowed to deduct the money on your tax return? Rollovers, how much are you allowed to get? Remember, you're allowed to get 80%. If you had, say, $100,000 in an account and you decided to roll it over, but you took the indirect route, in that you took the money and then you gave it on to another financial institution, they would only give you out of the 100,000 80, and then you would have to come up with the other 20 somehow, because to put it back in, you have to put all the money back in, even though you didn't get all the money. The first company would have kept 20% for federal tax purposes. So it's usually better to go ahead and just get a direct rollover. If it's all possible, then you don't have to worry about any of it. The required distribution was also there in Chapter 11. When do you have to start taking money out and how much? Then we went on and talked about selling of the home. Remember, you're allowed $250,000 of excludable gain if you're single and you've lived there for 2 years. However, if you live there, if you're married, you get up to $500,000 that you do not ever have to report, nor does it go on to the other the new home spaces. And then what happens if you sell your home early between 2 years, but you have a legitimate excuse? There were a couple factors listed in the book and in my notes that were some factors the IRS will look at. And if you only live there a year, they will give you 1 over the fraction, so 1/2 or half of that $250,000 off. So they would give you $125,000 excludable gain if you meet one of the criteria. And then the difference between a capital asset and Section 1231 asset. Remember, capital asset, they both have the gain option, the preferable gain treatment. If you have a capital asset, you can tax it at a lower percentage or even zero if you're in the low brackets. So they both give you that option, that lower gain percentage. The main difference between the two is the Section 1231 allows you to take all of your loss. Remember, with a capital loss, you can only take $3,000 per year off of your ordinary income. With a Section 1231 asset, or basically an asset that's in business, you can use all of that loss against your income and deduct it, and not just the $3,000. And we also talked about netting of gain and losses in that section as well. I believe it's chapter 7. Section 1245 and 1250, how are they alike and different? Remember, the Section 1245 is for your regular type business assets like a machine, couch, anything that's basically not property, and that's what Section 1250 is for, is property. They're almost identical, and what they mean, Section 1245, remember, is you're going to be taxed at your regular rate instead of the capital gain rate for any amount of depreciation you took. So you have to add back any of that depreciation at actual regular gain rates and not the capital gain rate, the lower rate. Section 1250 says you have to add them back at ordinary rates, but you can stop at 25%. So even if you're in the very upper limits, you can stop there at 25%, and you don't have to add all of your gain back at the highest rate. Definitely make sure you know the difference between a realized loss and a recognized loss. We went over that in quite detail for Chapter 7 and in Chapter 12. Casualty gains, remember, those are when you say you have a building in Florida and a hurricane comes through. Say the building is worth $200,000, and on your books it's worth, you depreciate and it's down to $120,000. The building gets destroyed and you get insurance money, $200,000 to cover it. Well, without a special tax rule, you would have a gain of $80,000 because you got something, $200,000, but you only gave up something worth $120,000 on your books because of the depreciation you took. However, with a casualty gain, if you reinvest your money within 2 years, 3 if it's real property, meaning like a building, then you don't have to report any of that $80,000 gain. And of course, know how to calculate the new updated basis. And we're going to have quite a few of those in the examples down below that we'll go through. So here's the basis, and just making sure you remember to have that in your notes as well. How to get the updated basis on like-kind exchanges or your deferring of casualty gain. How do you know what the basis is for any gifts or inheritances? Remember, with an inheritance, you get the stepped-up basis. So that's a really good deal for those receiving the money, or the property, I should say. The property, you get the higher basis. So if the grandpa had it 30 years ago and bought it for $100, but it's now worth $1,000, when he dies, you get it at the basis of $1,000. So if you would turn around and sell it, you would have no gain or loss to report. Just get the full money. Gifts are a little different. Make sure you go back to, I believe it's Chapter 7 that we talk about the gifts, and we'll do an example of that further down. How are things different between a hobby and a business? Remember, with a hobby, you cannot take any of the expenses. You have to strictly report your revenue, and that's it. You don't get to deduct cost of goods sold or anything. And the only exception to that is if you do itemize your deductions, you can take those expenses as an itemized deduction, but for a lot of people that are, I would just consider normal middle-class Americans, we don't have enough to itemize. And so taking that deduction doesn't help us at all. The good part about having a hobby, though, is that you don't have to pay self-employment taxes, which add up to be 15.3%. So that's quite a bit that you may not had budgeted for. In a business, you will have to pay that self-employment tax, but you can take a deduction on all of your reasonable business expenses, including the cost of goods sold. Chapter 6, I wanted you to know about the makers and what is a useful life for each type of category. So what's a useful life for a warehouse versus an apartment building versus a machine in a business versus a computer. They all have set tax life for depreciation purposes. And this goes up with it here, this last one. How is Section 179 treated? And the bonus depreciation, when you have assets, when can you use Section 179, when can you not? Same with bonuses, bonus depreciation, when can you use it and when can you not? And then finally what we talked about last week with Chapter 8 in the rental losses and vacation homes, knowing when to use the IRS method or when can you also use the tax court method. Remember, the tax court method is only for mortgage and real estate. And with the tax court method, the whole idea towards it is you can use less of the mortgage and real estate tax on your Schedule E and save more of it for Schedule A, which may hopefully boost you enough to be able to use Schedule A, and then also be able to use more of the other expenses on Schedule E, like depreciation. So you have that option to use the tax court method if it benefits you. Okay, let's go through some examples, and we'll go through till probably for about the next 40 minutes. And if we run out of time, I'll just stop and you can finish the rest, because I don't like the lectures to go much over an hour. But we'll see how far we get. Hopefully we'll get through most of them. So this gives us, this first one, an example of just a regular capital asset and what to do with its gain or loss. And this particular case is a personal use asset, and those are even a little different when it's a personal use asset. So he bought it in 1990 for $10,000, and now we sold it for $3,000. And then we have a separate situation here. We have a tractor we sold for $500, and we originally bought it pretty cheap for only $100. So what are we going to do? Realized and recognized gains, assuming 25% tax bracket. Well, the first one here would be a realized loss of $7,000, but for tax purposes, we can't count any of the loss because it's personal use. So that one, if it was a gain, we would have counted it, like we do down here with our used tractor. But for any losses, we just basically pretend it didn't happen because it doesn't affect anything for tax purposes. The tractor here, since we bought it for $100, there was a gain of $400. So if you were to follow the rules of the tax law, even though in this kind of situation, how many times does it happen? Probably not much. But the rule of tax law would say you would report a $400 capital gain. And since we're in the higher of the two income brackets, this would be a capital gain, and we would be able to report our gain and losses at the lower amount of 15%. Now let me pull up answers as well. And then note it's on Schedule D. Okay, let's go to example number 2. So we're selling stock. Remember, stocks are not necessarily considered like-kind exchanges. So when you buy and sell, that doesn't work in that aspect. However, the capital loss, the capital asset rule of the 3,000 limit does apply with stocks. So if you had a 5,000 loss and that was it, you could only take 3 of it. So let's look at what's going on here. Microsoft purchased well over a year ago, so this would be long-term. This would be a long-term gain for $3,000. So I would, as I'm going through these, I would note that down. You would write down long-term gain, $3,000. This stock here, also long-term, was sold for a loss of $3,500. So right now we can net those two, and we have a long-term loss of $500. And then our last one, we purchased it at the beginning of the year for $6,000. It's worth $5,000, so we have $5,500 loss. Short term, so we have a realized long-term loss of $500, short-term loss of $5,500. However, what's actually going to get reported or recognized would be a loss of only $3,000. The rest of it would get carried forward to next year and to be able to use the rest of it, as long as we didn't have any more loss to add on to it. Okay, so the company here sells a copier. We purchased it for $3,000, $0 left value because we depreciated it. What is the realized and recognized gain or loss, and how is it taxed? Okay, so this would be an example of definitely having a capital gain, and then knowing that it has a potential of being a Section 1245 depreciation recapture as well, and then doing the capital gain, if even necessary. Remember, with Section 1245, go back to your notes, and definitely remember that Section 1245 says your gain will be added back at the regular rate up to the smaller of whatever your depreciation is, or your realized gain. Anything after that is a capital gain. So with number 3, we have a realized gain of $1,000. We got $1,000 for it, minus what it was worth on our books, 0. So realized gain of $1,000. We had taken $3,000 in depreciation. So the lower of the realized gain or the depreciation, which would be the realized gain, that is our depreciation recapture. And so all 1,000 of the gain would be added back at our regular rate due to the Section 1245 recapture rules. None of it would be at the capital gain rate. Example 4. Okay, so we're going to do sell their small business building for a larger one. So here we're actually having a sale, and then we're going to go buy a new building. So this is not necessarily going to be a trade. They received $40,000, and they used the proceeds to purchase a new building. So whenever we get to determine what's our realized gain, I always have to do realized first. What did you get minus what did you give up? They got $40,000. They gave up $35,000. So we have a gain of $5,000. And that gain would be a Section 1250 because there was depreciation involved. Most likely, I don't specify, but most likely that's the reason the book value went down. So we have to add back the take the lower of the realized gain, 5, or the depreciation, 15. So all of the 5 realized gain is going to be taxed at the regular rate for Section 1250 up to 25%. So the recognized gain or loss would be the $5,000 gain at the Section 1250 rate. How is this taxed? As I just said, the basis in our new building would be the $100,000. This does not qualify for like-kind treatment. And hopefully you're going through these on my review sheet, on my answer sheet as well. And I state this one, recognized gain of $5,000, Yep. All right, let's go on to number 5. So this company has a big fire, so potential here for the capital gain areas. Building 50,000, it cost us 65. It's now worth 70, and that's what the insurance gives us. And they're going to rebuild a new building worth 65,000. So our realized gain or loss, remember, what did you get? 70 minus what you gave up. It was worth 50 on our books. So we have a 20,000 realized gain. However, we don't have to count all of that because most of it was put into a new building. So we only have to put the remainder that's still left as recognized gain. So our recognized gain is only 5,000. And then the basis of our new property, you always start with the old 50,000. And this one will turn out to be the same because you get to add up, you get to add into your basis any gain you recognize, but then the rule also states you need to subtract subtract the amount of cash you received from your basis. So we did receive an extra 5,000 that we didn't need to invest in. So that takes us back to 50,000, which was the price of our original building, or the value of our original building. Okay, we have a like-kind exchange here, land for land. So that's going to be important to make this exchange equal. Bill pays Jack 20,000, and he needed to because the fair market values were different. One piece of land was worth more than the other. So to make a equal exchange, some boot had to be involved, and that's, remember that term, boot. So what are the realized and recognized gain or losses and the basis of the new property? Okay, let's start with Bill. Easiest way to always go about this is write them down separate. What did Bill get? Bill got something worth 50,000, and Bill gave up 20, plus Bill gave up another 20 in cash. He gave up a book value asset of 20 plus another 20. So Bill has a realized gain of 10,000. But since it was a like-kind exchange and Bill actually gave the money, none of that 10,000 is going to be recognized. So we get to Bill's basis. We take always start with your old book value. So let's put down here to number 6. Old book value plus the cash that we had to pay, and then we didn't have any recognized gain or loss, so nothing was affected there. So our new basis is 40,000. Okay, go to Jack. What did Jack get? He got something worth 30. What did Jack? He also got. Sorry, we forgot about this. He got something worth 30, plus he got cash of 20, so he got 50,000 of stuff, less what he gave up on his books was 30, so he had a $20,000 realized gain, and it just happens to be that that's going to be the recognized amount as well, because Jack was the one that received boot. And whenever boot is received, that does trigger the gain component. And then you take the lower of the realized gain, or the boot. Lower of the boot or the realized gain. And so 20,000 of it will be recognized. The basis actually will even out and become exactly what he gave up, because he did pay money. Received money. So that lowers your basis, but then when you recognize a gain, that ups it back up. So that's a wash. Okay, so in this example 7, Andrea trades her personal farm tractor for other similar farm equipment. Andrea's tractor has a basis of $5,000. The new equipment is $2,000. What is her recognized gain or loss? What is the basis in the new asset? Notice this is not going to be considered a like kind, because for like kind it has to be business to business asset, and this one was not. It was personal use to business, and that doesn't count. So we had a realized loss of $3,000, but since it was personal use, you can't take any of it, so we lose it. Our new basis is simply what we got, what it's worth, and what our old tractor was worth, I should say. Now, assume the facts change just a little bit. Assume basis of 20, fair market value at trade is 30, so it went, instead of going down, it went up in value. Here we have a $10,000 gain, and we must treat it as a recognized gain. Again, it's not like kind, because it didn't go business to business. New basis, remember the key, always start with your old basis, plus any gain, minus any loss recognized, plus any cash paid, minus any cash received. Okay, example 8. This is a part of the gift part of chapter 7 and 12. Jane receives a gift of stocks from her brother. John bought the stocks over a year ago, so they're considered long-term, for $2,000. So that's John's basis, $2,000. The fair market value of the date of the gift, $1,000. So they went down. Jane actually sells them a couple years later, and they went back up. What's John's recognized gain or loss in this example in either of the years? And the answer is 0. He doesn't get any gain or loss since it was a gift. What's Jane's basis? Well, it kind of depends on how you want to talk about it. You could say, well, Jane's basis is the 1,000 that she received it for, knowing that she can possibly take an unused loss from her brother. So it's $1,000, but then there are some exceptions, which is going to be the case. So Jane's basis, she sold it for 25, had it on her books for 1,000, what it was worth when she got it. So she has a gain of $1,500. However, she gets to use this unused loss that her brother could not use, and so she has a final recognized gain of $500. You could say that her basis was $2,000, and you wouldn't have been wrong. And then knowing that she paid $2,500, so then you still have the same $500 recognized gain. That's the important part. Number 9. Jane receives a pay. Let's have another stock example. For John. John bought the stock for $2,000, and now the fair market value, instead of the other one, the fair market values went up. Jane sells it for higher still. John's recognized gain or loss would be 0. The giver doesn't get any recognized gain or loss. Jane's basis, well, we're definitely going to use the 2,000. It's not a kind of an iffy, well, what do you want to use? Because you possibly have a unused loss you can take advantage of. When the donor's basis is lower than the actual fair market value at the date of gift, and you use the donor's basis because the government doesn't want to lose that gain potential. So you bought it for, or you sold it for $4,500. What'd you get? Minus the basis of $2,000. So Jane's recognized gain here would be $2,500. Example 10. This is an inheritance. Mike received stocks from his grandfather. Grandfather bought it not that long ago, if we were thinking we were in 2014 still. He got it. The grandpa got it in July of 2014 for $5,000. He died later that year. In October, it went up in value to $6,000, and then Michael sells it for $6,500. So the stock's only been out in the family's hands for less than 6 months. However, Michael's basis is the $6,000, the stepped up value, and it's considered long term. Whenever you have an inheritance, it automatically becomes long term. And remember, the good thing about long term, which I didn't discuss up here, but with this one being long term, it's a capital gain, being over a year. So Jane gets the capital gain treatment for her stock. Therefore, she's paying a little bit lower gain than she typically would have under normal tax rate. So this would be a long-term gain of only $500 from what he sold it to what the basis was when he received it. Long-term, so he gets the capital gain. Okay, a single individual wants to participate in an IRA. Susan works full-time and participates in a qualified retirement plan. Her AGI is $60,000. How much can she contribute to the IRA? Now, I didn't update these numbers for the review. I should have. But I will give you the phase out like I do here on the exam, so you do not need to know the phase outs because they change every year. So I'll update this for future. But so the question is then, assuming these 2013 numbers, we'll assume that that's what year it is, and her AGI is 60,000. She's right there in that cutoff range. So she can't contribute the entire, remember, how much is she allowed to contribute to an IRA? Well, she's allowed to contribute $5,500. So that's what you're allowed for an IRA, but how much are you actually allowed to deduct? Well, since she's in the phase out, how I do it, and it's different than the book, but it's a one less step, and I think it's easier. Take your top phase out minus what the AGI is, so there's 8,000, and then divide it by the span, which is 10. So 8 divided by 10 is 80%, and you get 80% then of 5,500, which comes out to be $4,400. Now, I say assume everything is the same except Susan's AGI is now 80 instead of 60. She's still allowed to contribute to $5,500, but to deduct, she's over the limit, so 0. She can't deduct anything for her IRA contribution. Okay, 2 more. Company decides to trade their car for a different type of car. So it's going to be a like kind. Old truck, basis is 0, worth $5,000. And then we give Benesky's basis, the other company, and the fair market value of that car. They're not quite an even trade, so company number 1 does have to give company number 2 extra money to make the trade equal. And I want us to determine the realized and recognized gain or losses with this like-kind exchange, as well as the new basis. So let's do Oaks first. Oaks is getting something worth $10,000 because they're getting a car for $10,000 worth $10,000. They're giving up something worth 0, but they're also giving up cash. So 10,000 minus 0 minus 5,000. So they have a realized gain of 5,000. Recognized, since it's a like kind and they did not receive boot, recognized would be 0. No gain or loss for Oaks. New basis, well, you always start with your old, 0. Plus any gain, nope. Minus any loss, nope, there wasn't any of that. But we do get to add in the cash that was paid. So 0 plus 5,000, we have a basis of 5,000. Benesky, what did they get? They got something worth 5,000 from Oaks. They also got cash of 5. So they got something worth $10,000. They gave up something worth 7. So they have a realized gain of 3,000. Boot was received, so there will be a recognized gain, but the recognized gain is the lower of the realized, which was 3, or the cash received, 5. So our recognized gain is only 3,000, all of the gain that we did recognize. New basis, you always take your old basis plus any gain recognized. That was 3,000 that we just did. So now we're up to 10 minus cash received. So our basis is going to be $5,000. I hope you can follow in my answer key. Last example. We have a vacation home personal purposes for 28 days, so we are definitely, remember the difference between primarily rental, primarily personal, and then the combination of rental and personal. We have used this asset for more than 14 days and more than 10% of the days rented, so this is not primarily rental or primarily personal. It's a combo. And the thing about the combo is you can't have a net income go below 0. That's the only downside. She will itemize this year, so if she will itemize, we want to put as much of the expenses on Schedule A as we can, and then use as much depreciation before we go to 0 on Schedule E to hopefully get the best of both worlds. So for the mortgage and real estate taxes, she's going to want to use the tax court method, which remember the tax court method says take, and I know you can't see my calculator, but take the number of days, 84, and divide it by, we'll do 360 just to help it come out. Well, that didn't come out very nice. 84 divided by would be 365. That came out even worse. So we'll stick with 360. 84 divided by 360, 23.3%. That's how much she has to use for Schedule E, 23.3, instead of taking 28 divided by the total days used total. So not just 84, but total days, 28 divided by 84 plus 28, which would be 112, so 25%. There isn't that much difference between the tax court method in this case and the regular IRS method. Oh, well, sorry, that's personal. Rented is 84 divided by 112, so there is a big difference. 75% versus 23.3, or about 23%. Remember that when you make a mortgage payment, the amount that actually goes towards the loan is not deductible. That's just a return on your capital. That's not an expense. Okay, if you know this review guide pretty well and you can go through it, each of those examples and the things at the above, and have some notes on each one of those, plus go through the examples, a second time and compare it to the answers and not miss any, you should get at least a 75% on the exam. The exam is, I don't think it is tough because I cover a lot of stuff and I expect you to know a lot of things, and I don't just make it real easy, of course, like I probably saw in the midterm. But it is definitely passable, and if you take the time and really know this material on the review, you will get at least a 70%, or there you should, if you really do know your material and have good notes to remind yourself of certain rules. Well, that is all for this class. Hopefully you did enjoy and you got something out of it. This class I make from scratch, so it is a big ordeal for me to put this on every year, every semester, since it is something that gets updated every single year with all the tax law changes, and it's something that I have made personally. This class, it's not some big committee that goes in and makes the changes. So it does require a lot of work, but is one of my more favorite subjects, and I like to keep up to date, so it works out. With that, good luck on the final, and hopefully you will message me and tell me how the class went.